The month my friend Carol retired, HMRC took $3,400 from a single pension withdrawal. She'd asked her pension provider to release $12,000 from her personal pension. Money she needed to clear some home repairs before the winter. She was 61. She'd worked for 34 years. She had no other income that month. Her actual tax liability on that withdrawal was close to zero. HMRC took $3,400 anyway. Nobody rang her. Nobody wrote to her to explain what had happened. The pension provider sent the money, deducted the tax, and that was that. Carol assumed it must be right. She left it. That was 3 years ago. She's never reclaimed it. I'm going to show you exactly why that happens, exactly how much it could be costing you, and exactly how to get it back. Because the form exists, the process exists, and HMRC will pay within 30 days if you know what to ask for. My name is your name. I spent 8 years inside HMRC, first in the Pensions and Investments Compliance Unit, then as a senior tax officer, then on the internal guidance team, the team that writes the instructions the inspectors use when they're reading the rules in real life. I'm not on the payroll anymore, which means I can finally be straight with you about the things the system relies on you not knowing. This channel exists because the rules that protect your retirement income are all on the books. HMRC just doesn't write to tell you what they are. Here's the thing most people don't realise the day they retire. When you were working, your employer operated something called pay as you earn. Every month they received a tax code from HMRC, deducted exactly the right amount of tax from your wages, and sent it across. You never had to think about it. The system was automatic. The day you stop work, that system stops with you. From that moment forward, HMRC has to rebuild your tax picture from scratch using data fed in by your pension providers, the DWP, and your own personal tax account. That process is not instant. In practice, for many people, it takes months. And during that gap, between the day you retire and the day HMRC catches up, every financial decision you make can be taxed incorrectly. There are 3 specific ways this hits people who retire at or around 60. I'm going to walk through all 3, give you the exact numbers, and give you the exact words to use to fix each one. Let's start with the one that cost Carol $3,400. When you take your first flexible withdrawal from a defined contribution pension, that's a personal pension, a SIPP, a workplace DC scheme. Your pension provider almost certainly does not have your live tax code yet. They're required to apply something called an emergency month 1 tax code. Here's what that means in practice. The month 1 code assumes that whatever you've withdrawn in that single month, you will withdraw the same amount every single month for the rest of the tax year. So if you take $12,000 in one withdrawal, HMRC's system treats that as though you're earning $144,000 a year. Take a moment to let that land. A 60-year-old, no salary, no other income, takes $12,000 from their pension once. HMRC calculates tax as if they were earning $144,000 a year. At that projected income level, significant portions of your withdrawal are pushed into the higher rate tax band. The result is an effective tax rate that bears no relationship to what you actually owe. On a $12,000 one-off withdrawal, where the true liability is close to zero because you've barely touched your personal allowance of $12,570, the emergency code can generate an overcharge of $2,800 to $3,800, depending on exactly which code was applied. That is the gap between what HMRC took and what Carol owed. And here's the critical piece. The overcharge is not a mistake. It is the designed outcome of the emergency code system. The mechanism exists because HMRC has no way of knowing in real time whether your first withdrawal is genuinely a one-off or the first of 12. The remedy also exists. HMRC built 3 specific forms to reclaim this overpayment without waiting for the end of the tax year. Form P55. Use this if you took part of your pension pot and you plan to take more withdrawals in the same tax year. Form P50Z. Use this if you emptied your entire pension pot and you have no other taxable income. Form P53Z. Use this if you emptied your entire pension pot but you do have other taxable income. Your state pension, for instance, or a small workplace pension. All 3 are submitted through your personal tax account at gov.uk. HMRC's stated turnaround is 30 days. In my experience in the compliance unit, they usually move faster than that. The phrase I'd use when submitting, "I am reclaiming tax overpaid under an emergency month 1 code following my first flexible pension withdrawal. My actual income for this tax year does not support the annualized rate that was applied." That sentence tells the processing officer exactly what you're claiming and why, and it routes your form to the correct team rather than sitting in a general queue. Now, how much is sitting unclaimed out there? HMRC's own published data shows that in the first 3 months of the last tax year alone, they repaid $44.1 million to over 13,000 pensioners who submitted these forms. That is only the people who knew to claim. The people who don't know the carols, the money sits there. HMRC does not chase you to return it. The second issue is closely related, but it affects a different group. When you stop work, HMRC doesn't immediately know you've retired. Your employer stops submitting payroll data. The data flows that built your tax code dry up. HMRC doesn't notice this in real time, often not for weeks, sometimes not for months. Here's why that matters. Your state pension, which I'll come back to in a moment, is taxable income, but it is paid gross. HMRC takes nothing off at source. The way they collect the tax you owe on it is by quietly reducing the tax code on your private or workplace pension. That reduction happens through a process called a coding notice. HMRC sends a revised code to your pension provider and the deductions go up. If HMRC hasn't been told you've retired, they may not have all the information they need to set that code correctly. The result is one of two things. You overpay every month for the rest of the year, or you underpay and receive a tax bill in the post the following summer. Neither is ideal. Both are avoidable. The fix is a single phone call to HMRC on 0300 200 3300. The exact words I'd use: "I've recently retired. I want to make sure my tax code correctly reflects all of my pension income, so I'm not over or underpaying throughout the year." That sentence triggers what's called a full tax code reconciliation. Not just a single source update. It tells the agent you understand the system, and it flags your record for a proper review rather than a simple data entry change. If you're in Scotland, your tax code will have an S prefix, something like S1257L. The principle is identical, but the rates are different, so make sure you confirm you're a Scottish taxpayer during the call. One other thing while you're on that call: if you've moved house since you last had contact with HMRC, update your address. Letters from HMRC chasing tax you owe don't stop arriving at the old house just because the new owners are binning them. The liability is yours regardless. I want to deal with a misconception that I see at pension-wise appointments more than any other single thing. Your state pension does not arrive automatically. Let me say that again because it surprises almost everyone. Your state pension is claimed, not paid. The DWP sends you an invitation letter roughly 4 months before you reach state pension age, with a claim code printed on it. You use that code to claim online at gov.uk, get your state pension. First payment lands within 5 weeks. If you don't act on that letter, or if it doesn't arrive, or if you've moved and it goes to the wrong address, your state pension simply defers. Deferring can be a deliberate, financially sensible choice. It should not be an accidental one. The full new state pension right now is $221.20 a week, $11,502 a year. To receive the full amount you need 35 qualifying years of national insurance contributions or credits. 10 years is the minimum to receive anything at all. Here's the part that matters for your tax picture at 60. If you retire at 60 but you don't reach state pension age until 66 or 67, you have a window, potentially 6 or 7 years, where your only income is what you choose to draw from your pension. During that window, your personal allowance of $12,570 a year is entirely available to absorb pension withdrawals tax-free. Once your state pension starts, that $11,500 a year absorbs most of your personal allowance before you've drawn a single pound from your own pot. The tax-free headroom shrinks dramatically. Understanding that transition and planning your withdrawals around it can be worth thousands of pounds over the course of a retirement. I'll do a full video on the state pension timing decision specifically, because the numbers are significant, and the window for planning it closes the moment you claim. There's one more thing I want to cover today because most people who come to me have never had it explained clearly. In the right income structure, You can have $18,570 of income per year, including savings interest, without paying a single penny of tax. Here's how it stacks. Layer 1, your personal allowance, $12,570. This absorbs your pension income first. Layer 2, the starting rate for savings, up to $5,000 of savings interest taxed at 0%. This only applies once your non-savings income, state pension, stays below $17,570. For every pound of pension income above $12,570, this $5,000 allowance reduces by £1. Layer 3, the personal savings allowance, $1,000 for basic rate taxpayers, $500 for higher rate, 0 for additional rate. Stack all three for someone drawing a pension below $12,470, and the total tax-free allowance on savings interest reaches $18,570. With savings rates where they've been for the last 2 to 3 years, an ordinary cash savings account can now generate enough interest to pull people into tax without them realising it. If you moved money into an ISA recently, good. ISA interest doesn't count toward any of these thresholds. It's tax-free regardless and completely separate. But if you still have significant savings in standard accounts, and your tax code has been adjusted to collect tax on estimated savings interest you may no longer be earning at the same rate. That adjustment may be wrong. Ring 0300 200 3300 and say, my savings interest is now within my personal savings allowance and starting rate for savings. Please remove the savings income adjustment from my tax code for the current year. That one sentence is worth $200 to $400 a year for people who've moved money to ISAs but haven't told HMRC. Let me bring this together. The $3,400 that Carol lost. That was the emergency tax code on a first pension withdrawal. The reclaim form exists, P55, P50Z or P53Z, through your personal tax account. HMRC will repay within 30 days. She just didn't know to ask. There are thousands of people in the same position right now, not because the rules are unfair, because the connection between the rule and the remedy isn't something HMRC puts in a letter. Before I go, I want to flag something that is sitting on the horizon for everyone with a pension pot. And if you're planning your retirement around the idea that your pension sits outside your estate for inheritance tax, you need to hear this. From April 2027, that changes. Unused defined contribution pension pots will be brought into your estate and subject to 40% inheritance tax for the first time since 2015. The window to restructure is open now. It will not be open forever. I'm doing a full video on exactly what that means, what the options are, and what the gifting rules allow. Coming next week. If you found today useful, subscribe so it lands. And if you know someone who retired recently and took their first pension withdrawal without knowing about the emergency code, send them this. It may be the most useful 14 minutes they spend this week. Take care of yourselves.